Well, joining us now for a bull and a semi-bear, I guess, debate, if you will, if I can call Chuck that, from San Francisco, Chuck Jones, technology analyst at Atlantic Trust Private Wealth Management. He is not positive on the company's business outlook, but not overly negative as well. David Dahl, President and CEO of Canley Trust Company, who is a shareholder of Dell and has a favorable view on the stock. He is joining us from Houston. Welcome to you both. You know, let's go back now to David. And David, you're more optimistic on the company, but I got to ask you, you hear about this sort of retail change of heart. The whole company was built on this low-cost direct sales model. All of a sudden they say, hey, let's go to retail. Is it kind of, I mean, shouldn't that throw investors for a loop that they suddenly decided to almost reverse their previous entire strategy?
Well, changes were absolutely necessary. We had some financial irregularities in their reporting back last year around this time, and since Michael Dell has come back in, you've seen a four-phased prong approach in terms of restructuring. You've mentioned a couple of those, Brian. The retailing, the announcement this week with Carrefour over in Europe, really allows Dell to get a much stronger foothold in their European operations, to go into that distribution channel. From an investor standpoint, your question is, do you continue with a company that's floundering from their original mission? We had significant customer service issues that needed to be addressed, and this retailing channel is part of addressing that.
But isn't it going to hit their operating margins? I mean, wasn't that the entire basis of the direct sales and build-to-order model? Keep inventory leans. Now they got to build up inventory to ship them out to retailers who are going to eat into their once famed operating margin model.
Well, that's exactly right. Chuck just mentioned that, but there's a trade-off here. One of the things that Dell noted back in the spring when he announced the necessity for layoffs, retooling of the company, was that they were not going to be reducing some of their efforts in R&D and in customer service. So a company that continues to mature has to determine where it wants to spend. Operating margins thus far haven't been hit, as Chuck just noted, but the issues for Dell are one of focusing on retail distribution channels, because their model that had been so successful had started to flounder.
So while we just hit these issues, is there a way for value investors to say, yeah, they got their issues, but guess what? It is still undervalued compared to some of its competitors?
You know, I would say it's not necessarily undervalued. It's probably, I'd say, more unequal to sort of fairly valued with them. In that comparison to Apple, different operating margins, also different product mix with the iPods and the iPhones for Apple. When I take a look at valuations, say free cash flow to market cap, Dell's trading about the same as HP on calendar 08 at a slightly more expensive 16+ ratio on a PE multiple basis versus HP at a 14+ multiple. So with sort of similar growth rates on the bottom line, right now I'm again towards HP because it's just got overall better growth rates.
You know,
well, Chuck,
go ahead, David. Jump in.
Chuck, yeah, excuse me just a second, Chuck, because I think you hit on a key thing there, and that's that net free cash flow. We see Dell with about $1 billion in net free cash flow a quarter, and you're exactly right. They trail HP, but the marginal difference has been shrinking. Some of the efforts that Michael Dell has put back in place are stimulating the net free cash flow. And your observation about the product differential between Apple and even in HP with the substantial printer sales that are going on, that shouldn't be missed in the equation. Dell fits in with a theme that is large growth that has the ability to generate free cash flow. And Brian, your statement about potentially being a value-oriented play relative to the others is exactly what we see in this point of the product life cycle.
Yeah, and what about the cash balance? Not cash flow, but cash balance. They've got about 20% of cash on their books compared to their market cap. David, do you feel like investors haven't focused on that enough, and that they are getting just actually some money for their investment dollar back from Dell?
Well, I'm not sure focusing on the cash is the real issue when you invest in a growth company. The return on that's pretty minimal.
But is it a growth company? That's the question. Is this a growth company? That was what I was trying to get at with the point on valuation. You know, Dell's not what it used to be.
Well, not what it used to be, but it is a maturing company. And so we have a consensus estimate that's going to be around 35 cents for earnings today. That's going to be up 16% year over year. Last I checked, 16% isn't a company in decline either. We look at unit shipments, notebook sales. They beat on last quarter. We expect them to beat again. What they do with the cash is going to be crucial.
All right, David Dahl of Canley Trust, thank you very much. And Chuck Jones from Atlantic Trust out in San Fran, thank you both very much.